Hello, welcome back. So in today's video, I'll be talking about my biggest winners as well as my biggest losers in my portfolio today. So for reference, this is my portfolio. So I own many different companies here. I own companies like HCC, like MSCI, like Microsoft, and so on. And today I'll be talking about my biggest winners as well as my biggest losers in this entire portfolio. So for reference, this is my return profile for all these different stocks. So if you're interested in calculating the average cost, you can go and check it out. But of course, the biggest losers, the biggest sole loser is actually United Health. It is down around 26% on my average cost. And my biggest winners have actually been Meta as well as Microsoft. So I'll be covering my biggest losers, my laggards, as well as my biggest winner in this entire portfolio. So the first stock that I'll be covering as my biggest loser, it is actually United Health. So United Health year to date is down around 50%. It is currently trading at a 10 times of earnings, trading at a dividend yield of around 3.5%. So why did I buy United Health? United Health is a company that has fundamentally shown strength, and the company's earnings have been quite reliable over the past few years, past 10 years, past 20 years. United Health is facing headwinds right now, but the company will be able to restore their margins very soon. So starting from next year, they will increase the prices for their premiums, which will definitely help the margins of the company. And besides that, the company is a small size position in my portfolio, and this is sort of like a bet on the upside when the company eventually recovers under the new CEO, which is Stephen Hemsley. So for United Health, if you are to look at the earnings profile of this company, over the past 20 years, the company has been a true compounder, and only recently we've seen some form of earnings revision to the downside. So what happened over here was actually the cybersecurity issue under their previous CEO, which was Andrew Whitty, and currently we're seeing decline in earnings as well because of the higher medical cost ratio, which is pulling down the margins for the company. But overall, if you're to look at the historical earnings power for this company, the company is very strong fundamentally, and that was one of the reasons why I bought into the company. And besides that, if you're to look at United Health's valuation today, if you're to put a 0% free cash flow growth over the next 10 years, United Health's current intrinsic value will be around $327. So the markets are currently pricing in negative free cash flow growth for this company, which might be possible, but I think it is highly unlikely over a 10-year period. So for United Health today, I think it is a company that is trading at a decent discount, and I'll continue holding on to this company under their new CEO, which is Stephen Hemsley. The next stock that I'll be covering as well is MSCI. So MSCI is my second laggard in my entire portfolio. The company has basically given me no returns ever since I started buying it. The company is down around 8% year to date, and it is currently trading at a 36 times of earnings. So for MSCI, why did I buy into the company? MSCI is a stable, predictable business that will stay around for a very long time. It is the king of your indexes outside of the US, and the customers have extremely high switching costs as well. So imagine you're an MSCI customer, you have all your workflows, all your ETFs, everything tied up to MSCI, and you have clients passing you money to manage because you have the MSCI branding, you have the MSCI logo attached to your ETFs. It is almost impossible for any company in that situation to switch out of MSCI, which is one of the strongest moats for the company, besides the network effects, as well as the brand value of the company's name itself. So the company has strong secular tailwinds and pricing power, so they typically increase the prices by around mid-single digit every single year. That is above the rate of inflation. And besides that, the company has strong secular tailwinds, so as people move from passive to active investing, as more people pile money into the market, as the US economy prints more money, you will see more money being tied up to assets, which is overall bullish for MSCI. And the company has incredible operating leverage as well. If you're to look at the margins for the company has somehow been able to increase the margins all this time, although their margins are actually quite elevated already. So for MSCI, this is why I bought into the company. Although the company is lagging in terms of performance, I view this as a high quality business, and that's why I have a significant portion in MSCI today. So for MSCI's valuation, if you're to look at it from a historical basis, so their current valuation is similar to their 2024 drop, when the company actually dropped around 20% over the span of 2 days because of a slight miss in terms of the retention rate. So for MSCI, historically, the company is around fair value or maybe slightly undervalued. And for a quality compounder like MSCI, it definitely deserves a higher multiple as compared to your average S&P 500 company. So the third laggard that I'll be talking about as well is ASML. So ASML year to date is up around 3%. It is currently still trading at around a 24 times of earnings. So for ASML, why did I buy into the company? First of all, the company is the largest lithography company in the entire world, probably one of the most important ones out there as well. So besides TSMC, ASML is probably the next most important chip company in the entire world. And the company is a complete monopoly in your EV segment, as well as a large share in your DUV segment. So if you're thinking of a technological moat, ASML basically has every component of it under the business itself, and that's why I bought into ASML. So for ASML, here are some of the risks with the company. So first of all, ASML is reliant on Chinese revenue. So they currently have around 20 to 25% of their revenue coming in from China, and export restrictions could hurt that portion of the business. But of course, Trump is now reversing course. He's trying to put all of US tech into China so that the Chinese tech industry becomes increasingly reliant on the US tech, so that Huawei will lose market share there. I mean, that's his approach today. And the other risk with ASML is the growing reliance on complexity of the chips instead of the volume of the chips itself. So for ASML, they don't benefit as much when your volumes increase. They benefit greatly when complexity increase, when customers have to switch from, for example, DUV to EUV lithography so that they can keep up with litho intensity. So complexity is the one that is driving growth today, and unless this AI story is still in the early innings, ASML won't benefit as much as compared to TSMC. And besides that, ASML is prone to a slowdown in AI as well. The company is not a direct beneficiary of AI because volume increases won't help them massively. But of course, if we see a reduction in AI spend, then ASML's earnings will be hurt as well, which is sort of like a double whammy for the company. But for ASML, the company is trading at a historical low valuation. So the company's stock price has actually been flat for around a year or so. And during that period, the valuation of the company has actually declined. So the company is cheap, but the downside risks are there for this company. And that's why I'm not planning to increase my position. The downside risk for this company is a lot higher as compared to all my different other companies. You could think of it as high risk, high reward, of course. And for me, I prefer to hold low risk and high reward companies, and ASML is probably not one of them. And that's why I'm planning to hold my position, but I'm probably not planning to increase my position anytime soon. So next portion, I'll be talking about my biggest winners in my entire portfolio. So my biggest winner is actually Meta. Meta is up around 28% year to date after being up more than 50% last year. The company is actually trading at a 27 times of earnings today. So for Meta, if you have to look at the company's performance were just stellar. I mean, in Q2 of this year, the diluted EPS went up by 38%, net income went up by 36%, revenues went up by 22%, and costs only went up by around 12%. So from a fundamental perspective, Meta is performing very well. The company is executing well, fundamentally. But of course, there are concerns with Meta as well. So my first concern with Meta is this. Meta is planning to invest a lot of money into your data centers. While the investments have probably yielded returns for them, I mean, we saw an earnings acceleration for the company. But in this scenario, the company is actually planning to raise equity as well as debt to fund all these data centers, which I don't agree with. There's no other AI company doing this. I mean, if you have to look at all your different other hyperscalers, I don't think they're raising debt as well as equity to fund their data centers. All the other companies that have healthy cash flows to support the reinvestments in case the reinvestments go south. So in Meta's case, they're actually adding leverage into all these different data centers, which is what I don't like with the company, especially since it is a higher risk method as compared to all your different other hyperscalers. So for Meta, there's another concern as well. So if you have to look at the depreciation as well as the amortization, their D&A only went up by around 20%. And if you have to compare this to the capex of the company's capex went up by 100% year on year. So this could mean a few things. They're stretching out the depreciation and amortization, or the capex that they're putting into the company has some form of delay in terms of the operations, and that's why the depreciation and amortization only went up by around 20%. So there are a few risks with this, especially with this capex explosion. We could see a lot more D&A in the future, which will hurt the bottom line growth of the company. So currently the capex is only hurting the free cash flow, but in the future, if we see more depreciation, if the company can't yield returns, then you will see the bottom line growth getting hit as well, which is bad for the company. And that is my concern with Meta today. My next second biggest winner is actually Microsoft. So Microsoft year to date is up around 24%. It is currently trading at a 38 times of earnings. So for Microsoft, the company actually performed very well in their latest quarter. So their revenue went up by 18%, net income went up by 24%, diluted EPS went up by 24% as well. So the company saw an acceleration in terms of growth, and for a company that is already so big like Microsoft, it is quite remarkable seeing this acceleration in growth. So for Microsoft, they showed that they have incredible pricing power as well. For the first time since around 2012, the company actually increased the prices of the Microsoft 365 by around 30%. And they definitely have the power to continue doing so. So we have to see how that one plays out. And for Microsoft, my main concern with the company is just this. The company's valuation is a bit too high. So the company is trading at a 38 times of earnings. But for a juggernaut like this, I don't think valuation is a consideration unless the valuation gets a bit too overstretched. So for Microsoft, it is a diversified, recurring revenue business that has incredible pricing power, and it is almost a mission critical business as well. So your enterprises, they have no way of switching away from Microsoft. Microsoft provides the best bundle for them, the most valuable bundle deal, and that is the switching cost for customers buying your Microsoft products. And that's why I think Microsoft is basically a buy and hold forever company, and I'll be continually holding on to this company over the next few years unless the valuation gets a bit too overstretched. Next portion, I'll be talking about my style of investing. So my style of investing is as such. My preference is to buy exceedingly high quality business with strong runways of growth that is able to defend a market share that is called a moat. I like certain catalyst related plays as well, like Warrior Met Coal, as well as some Singapore companies in the REIT sector, and with your interest rates expected to come down over time, this will help to boost the earnings of all these different REITs in Singapore. And currently there are a few companies that are fitting the bill. So the first one is actually FICO. FICO is a company that is exceedingly high quality. It is almost fully embedded in your consumer credit portion in the US, and this is actually a company that I'm looking at. The other company is Copart. Copart is a company that auctions your cars. It has a very sticky business for all your different insurance companies, and it has the network effect similar to Amazon, and it is operating in a duopoly that has always been like this for years. So this company is actually another one that I'm interested in. And the last one is Otis. Otis operates in an oligopoly, and in Singapore, for example, if you have to look around, a lot of the lifts are actually serviced by Otis. So Otis is a highly recurring revenue business. Most of the net income actually comes in from that services portion, which is highly recurring, and they can probably increase prices at levels above inflation for that portion of the business. So for these three companies here, they are the ones that I'm actively tracking, and I'll be providing an update soon. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what are your thoughts on Abercrombie & Fitch? So Abercrombie & Fitch is a company in your retail clothing segment. It is a competitor to American Eagle. And for me, I don't think investing in retail is an approach that you should be taking. Because all your different clothing companies, firstly, they're not rated by Wall Street. Secondly, their earnings are actually quite cyclical. So when a company is exceedingly popular, the earnings will go up. And so it is sort of like a fad when it comes to owning all these retail companies. And in the space currently, I feel the better investment would be to invest in American Eagle jeans. The next question, it says, are you exploring AI in China? Not much on this area since the DeepSeek moment. So in China, you have a few AI companies like Alibaba, like Tencent. I think Huawei as well, but Huawei is not really publicly listed. So Baba is actually a company that I've considered over the past few months. But there are a few problems when it comes to investing in Alibaba. So first of all, the retail segment is a highly competitive one, and Alibaba still derives a majority of their net income from that segment. So in China, a lot of the retail companies, what they will do is they will lower margins to gain more market share, which will destroy the entire oligopolistic market in China. And that is what I don't like. That will hurt the margins of Baba's retail segment. And unless we see strong retail numbers, Alibaba's retail segment will likely still be weak. The other portion is the company's capex into your AI data centers. So the last time they did that in 2022, it turned out to be a failure when it comes to reinvesting into the business. And that is the portion that is a worry for investors today, like myself as well. So for Alibaba, it is a company that I'm considering. Hopefully it gets to a cheap enough valuation for me to think about entering. But for now, I'll be staying out of Alibaba. I don't think it is the highest quality business out there. So I've recently created this membership program here. Hopefully we can build a bigger community together so that everyone can learn off of each other. Feel free to check it out if you're interested. I hope you guys have found this one useful and invest safe.